I want to start with something simple and maybe a little uncomfortable. For most of my career, people have been told the same story about money. Save it. Put it in the bank. Avoid risk. Wait for certainty. It sounds responsible. It feels safe. And yet, after decades in business and investing, I have learned that this story quietly destroys more wealth than almost any market crash ever could. When I sit across the table from entrepreneurs, families, or retirees, I hear the same concern over and over again. I have cash in the bank, Kevin. I should be fine, right? That question matters because what used to be true is no longer true. Cash used to be a refuge. Today, it is a tool that must be used carefully, or it becomes a liability. In this video, I want to explain why so many people misunderstand financial risk, why holding cash feels safe but is often quietly dangerous, and how I actually think about protecting and growing capital in the real world. Not with fear, not with hype, with clarity. Because understanding earns trust, and trust earns long-term success. For decades, the financial environment rewarded caution. Interest rates were low but stable. Inflation was modest. You could hold cash without losing much purchasing power. So people built habits around that reality. They parked money in savings accounts. They waited for the perfect moment. They told themselves they were being prudent. But the environment changed. Rates moved. Inflation surged. Prices did not fall back the way people expected, and the old habits stayed. This is where the misunderstanding begins. Many people assume that higher interest rates automatically make cash safe again. They see 2 or 3% in a savings account and feel relieved. But safety is not about the number on your statement. Safety is about what your money can actually buy over time. If inflation is running at 5 or 6% and your cash earns 2%, you are losing purchasing power every single year. Quietly, relentlessly. That loss does not feel dramatic. There is no headline. There is no alarm bell. But over 10 or 20 years, it reshapes your entire financial future. This is not a prediction. It is simply math and incentives. So what is really happening beneath the surface? Banks take your cash and pay you very little for it. Then they lend it out at much higher rates. They profit from the spread. You absorb the inflation risk. This is not malicious. It is how the system works. The risk is not volatility. The risk is stagnation. When your money does nothing, inflation does everything. That is why I say cash is not a destination. It is a tool. Its purpose is flexibility. Cash allows you to act when opportunity appears. It protects you from short-term shocks. It gives you optionality. But when cash becomes a long-term strategy instead of a short-term tool, it quietly becomes your enemy. I think of cash like ice in a warm room. At first, it looks solid, reliable, safe. But the warmth is inflation. And over time, the ice melts, even though nothing dramatic happens. That is the core mechanism most people misunderstand. When I evaluate financial risk, I do not ask, will this be volatile next month? I ask, will this preserve and grow purchasing power over decades? That is the only question that matters. Risk is not just what you might lose. Risk is what you fail to gain by doing nothing. Early in my career, I made the same mistake many people make. I hoarded cash during uncertain markets. I told myself I was being disciplined. And then I watched my purchasing power shrink while productive assets quietly compounded. That was my wake-up call. Not because I lost money, but because I realized I was wasting time. Time is the most expensive asset you will ever own. Once you understand that, your relationship with money changes permanently. This is how I think about capital today. First, every dollar must have a job. Either it produces income, or it preserves purchasing power, or it gives me flexibility for opportunity. If it does none of those things, it is failing. Second, safety is not about avoiding movement. It is about building resilience. Resilient portfolios adapt to inflation. They generate cash flow. They do not rely on a single outcome. Third, discipline matters more than timing. You do not need perfect clarity. You need a thoughtful process that evolves with reality. That is how the wealthy actually manage risk, not by guessing the future, but by building systems that survive it. Let me show you how this plays out in practice. I keep cash, but only what I need for flexibility and short-term security, 3 to 6 months of expenses. Sometimes more if I am preparing for a large investment. Beyond that, I move capital into productive assets, not because I am reckless, but because I understand what stagnation costs. Gold is one example. I do not buy gold because I expect it to double next year. I buy gold because it has preserved purchasing power for thousands of years. Every paper currency eventually fails. Gold does not care about politics, central banks, or headlines. It is not growth, it is insurance. A small allocation creates stability when everything else becomes noisy. That is how I use it. Then there are income-producing businesses. Dividend-paying companies are the backbone of my strategy. When you own them, you are not speculating. You are participating in real economic activity. They sell products, they deliver services, they generate profits, and they send you a portion of those profits every quarter. That income grows over time. It adjusts with inflation. It compounds. This is how wealth is built quietly and patiently, not with excitement, with consistency. Boring is beautiful when it produces reliable cash flow. Real estate plays a similar role, not because property is glamorous, but because it is useful. People need places to live. Businesses need space to operate. That demand does not disappear. Real estate generates income. It adjusts with inflation, and over long periods, it appreciates. You do not have to be a landlord to benefit. Real estate investment trusts allow you to participate without managing toilets or tenants. Again, the point is not speculation. The point is resilience. But here is the asset most people overlook: your skills, your ability to earn. No market crash can take that from you. The highest return investment I have ever made was not a stock or a building. It was learning how to create value. Every wealthy person I know invested in themselves first. They learned how to sell, how to build, how to lead, how to solve problems. That is the foundation of everything else. If you increase your earning power, every other financial decision becomes easier. This is why misunderstanding risk is so dangerous. People obsess over market movements while ignoring the one asset they control completely: themselves. Finally, I use a small portion of my capital for alternatives. Not because I need excitement, but because diversification reduces fragility. Private businesses, selective technology exposure, a modest allocation to digital assets, never large enough to threaten my foundation, large enough to benefit from long-term innovation. This is not about chasing returns. It is about building a system that survives uncertainty. So, what changes for you? First, stop thinking of cash as safety. Start thinking of it as a tool. Ask how long you actually need it to sit idle. Then, give the rest a purpose. Second, evaluate assets based on purchasing power, not price movement. Does it generate income? Does it adjust with inflation? Does it build resilience? If not, it is not safe. Third, invest in yourself relentlessly. Your skills are your most powerful hedge against uncertainty. Let me be clear, I am not saying banks are collapsing. I'm not saying the world is ending. I am not saying abandon cash. What I am saying is this. The biggest financial mistake today is believing that doing nothing is safe. It is not. The real danger is quiet erosion. The real opportunity is thoughtful action. At the beginning, I said cash used to be a refuge. It still can be, but only when you understand its limits. I treat cash as a bridge, not a destination. It connects me to opportunity. It gives me flexibility, but it does not build my future. Assets do that. Understanding this changed my entire career. It removed fear. It replaced panic with process. It turned uncertainty into clarity. That is how I manage risk, not by predicting the future, by building a system that works in any future. And once you understand that, money stops being a source of anxiety. It becomes a tool you control. That is the real safety.